Financial education is something I'm passionate about. I don't think enough financial education is out there in the world. It's one thing to make money, it's another thing to keep money and grow money. Okay, so yes, that's right. But that's not my area of expertise. So I'm gonna bring on someone who's a friend of mine. I wanna introduce him. His name is Dustin. Can you please come up, Dustin, from Presidio Capital Management. He also is Retirement 101, and he's a top 40 under 40 financial advisors in the entire country. Dustin! Go get him, man. Right. Go get him.
Loan signing system. You guys having a good conference? Yeah. Oh my gosh, you guys are learning stuff. Who's learning stuff? Who's gonna be learning stuff that they're gonna put back into their business over the next 12 months? Put back into the business and make more money over the next 12 months. Who's gonna save more money over the next 12 months? You liars. Oh, come on. It's American after all. We gotta spend it, right? Who feels like they're not saving enough? Show of hands. Yeah, that's all right. You can be honest, that's fine, right? We're not. So I wanna talk to you. You guys are doing, look, wealth creation, becoming wealthy, right? The first step is you have to make the money, right? You have to go ahead and find some gainful employment, get that income. Then you have to get efficient at making the money, which is what you guys are doing right now, being at this conference. I applaud you for being at this conference. Making the best investment you can make is in yourselves and in your business. Step 3, as the wealth manager, I'm gonna argue is the most important step, right? It's creating that wealth. What are you gonna do with the money as it comes in? And it feels depressing sometimes. We feel a little defeated, right, when we see that meme post of the cup of coffee a day. You guys heard that? The proverbial cup of coffee a day to get wealthy? Kind of roll our eyes. Look, there's just been a massive lack of financial understanding in this country. And the thing about building wealth is when it's working, it doesn't look like it's working. Okay, so I have a saying that I use in my course and with my clients is it's just math. Okay, so I have a little whiteboard here. I'm gonna go over some basic financial concepts with you today to help open your mind, crack your mind open as to what is possible for you. I know we all wish we started sooner. We all wish we did more in the past. That's done. Forgive yourself, move on, start today. Okay? So, before I get into my material today, though, I'd like to play a little game. Okay? Shoulda, coulda, woulda. This game is called What If. All right? So I have some artifacts on me. This one, I don't know if you can see it here. This is, anybody know what this is? This is the iPhone. You have something similar, right? This thing has some weight on it. Original iPhone. Some of you guys probably still have this original iPhone in your pocket, one or two of you, right? 2007, it came out. June 29th of 2007. The smartphone came out. Wow, did it change things? For the better? Think so, right? It changed it no matter what. And it retailed for $499. Right, $499. And compared to what we were dealing with at the time, wow, what an upgrade. What an easy decision, right? We went out and we bought it in droves. $499. Now, here's where the game comes in. What if instead of buying this phone, you took that same amount of money and invested it in the company that was selling you the product? Any idea of how much money that would be worth today? $15,000. Okay, so $500 goes to $15,000, right? In just 14 years. And I have this. What an expensive hunk of junk I'm holding, right? I had to dig through some junk drawers to find, literally in a junk drawer. $15,000 is what I could have had. I had this instead, right? What about its predecessor, right? You guys remember this one? I had to really dig for this one, okay? Only reason I found my iPod is because my son thought it was so cool. He had to show his friends that we actually had an iPod in the house, right? Man, did this change things, though. Came out in 2001, retailed for $399. You guys remember what we did before the iPod? You guys remember going to the gym or running with that manhole cover strapped to your hand, right? 13 songs to choose from, you only like 3 of them on the album. That was how we used to live. Oh my gosh. So for $399, yes please. Yes please, I will take that. But what if? What if I took that $399 and invested it in the company that was selling me the product instead? Over $156,000 today. This hunk of junk is worth $156,000. I mean, what if you just did both, right? I mean, you got to have the music and the phone, but what if you did both, right? Maybe that's a way that we could start thinking about it. You guys running through all the stuff that you've bought over the last 30 days? Year to date? How much money is that going to be 10, 15, 20 years from now? Anybody notice my shoes when I walked out here? I mean, what kind of wealth manager wears a fresh pair of J's out here on the stage, right? Only partially for the fashion statement, okay? But my final product in our game of what if, right? These are Jordans, Air Jordans. Came out in 1985. Man, I grew up as a kid in the 80s, and the boys that had the Jordans, they were just so cool. I mean, I just begged my mom for them. I had the Jordashes. I don't know if you guys remember, Jordache had a knockoff brand, right? Because these were selling for $65. And who in their right mind would pay $65 for a pair of sneakers? Okay? Now, what if my mom had taken that $65 savings and invested it in the company that was making the product over $120,000 today? Guys, we make these decisions all the time, every day. You guys are making the money. You're investing in yourselves. Let's talk about some of these decisions and how important it is. Okay? Because over time, these little things that we decide to do are going to really add up. How do you become wealthy? There's a lot of get-rich-quick schemes out there. This is why I love being at this conference, because I'm not talking to those people, right? You guys are investing in something for the long run that's going to build on itself, and creating wealth is the same way, okay? So let's talk about it. I want to talk to you about the 3 best ways to accrue wealth. Now, I work with lots of wealthy people, successful people, and so I want to tell you what they've done and how they've gotten there. I've also, for every successful, wealthy person I've met 10 or 20 not successful people, so I want to share those stories too. Okay, so just focus on the things that create wealth, avoid the things that destroy it. You guys will be doing pretty well. All right, so the 3 best ways to accrue wealth: own and operate a business, invest in real estate, dollar cost average into the stock market. Now, you all get to put a big check mark on number 1 already, right? So good job. You're a third of the way there. Good job. You're doing it at a high level. Getting here at this conference, investing in yourself, making more money, getting efficient with that time to money transfer. Okay, number 2. Anybody have a goal to invest or have already invested in real estate? All right, lots of you. Very good. Now, real estate builds enormous wealth over time, and it's likely not for the reasons you think. Right? Is it because it's the best investment? Because it has the highest rate of return? There's a couple things about it that make it really successful, right? Most of which prevents us from being stupid with it. Because that's how we are with our investments, right? We have some fear and greed and emotions at play, and so sometimes real estate is a really great equalizer on that. Okay, it takes some time to think about having to bail out of your real estate, right? If you've invested in real estate, right? A lot of people have questions about the market today. Is it going up? Is it going down? Right? And you have to kind of pause. You guys know this very well, right? You're at the table a lot, but you have to make some decisions, talk to some people, hire some people, versus sending an email or hitting a button on your app to bail out of your stock account, right? So it's illiquid, which makes it a very long-term investment, which helps people, okay? Also, it's very risky. Investing in real estate is very risky, and we just don't know it. But investors who take risk, have you guys heard this? And the more risk you take, the more potential reward you will have over time. Okay? So that's a theory that holds true over long periods of time. Now, let me just kind of do some math for you. And this is where I need, yep, perfect, you're right on it, good job. You can see me in the back, you, pointing at you. All right. So let's say you wanted to buy a $500,000 piece of property. Now, by a show of hands, how many people are going to wait until they have $500,000 saved before they buy that property? I see 2 hands, and I don't believe you. Right? You guys know what you're going to do. You're going to find out what's the minimum down payment I need to make, right, before I'm going to buy this property. And there's nothing wrong with that. I love that. All right, so I'm maybe going to put $100,000, and I'm going to finance the rest with debt, right? Something like that. Now, when I'm investing, any investment has this total return formula, which is simply the income paid to me from that investment plus the growth. So, is real estate a good income investment? I mean, saddled with this $400,000 mortgage, I don't think you're going to be cash flowing pretty well on this property, right? Maybe I'd be lucky to kind of get a break even on my total return. But what about the growth potential of real estate here? You guys know what real estate averages as a rate of return? It's got to be kind of close to inflation. Okay, think of inflation as the cost of living. Real estate, where we live, is a big part of our budget, right? So it can't be too far outside of inflation. I know there's pockets of the country, many of which you live in, and you've experienced tremendous growth over periods of time, right? And that's very good too if you can catch those trends. But let's just say it's 3 to 5% on average over long periods of time. 20 or 30 year averages, you're going to kind of get to that 3 to 5%, depending on whether you're in the peak or the valley of the recession. You guys with me so far? Yeah. Okay. So let's assume you get a 4% return, right? So I got no growth, no income, and I get a 4% growth rate. That's a 4% total return, right? Not really. Because my 4% is on the 500,000. Okay? So if let's just do the math. It's just math. $500,000 times 4% is my average growth rate. That's $20,000. I've appreciated. How much did you invest? 100. So what's 20,000 over 100? My growth rate's not 4%, it's 20%. That's a pretty good rate of return. If I have real estate just do 4%, my net return is 20. You guys like a 20% return on your investment? Yeah. All right. What if real estate goes down by 4%? You've lost 20, right? What if real estate goes down by 10%? You've actually lost 50. Okay? Now, do you guys know how to make money in investing? I bet you do. I'm going to say the first part, you say the second part. Buy low. Okay. You guys know how to lose money? Buy high. You guys are pros. Okay? Make money. Don't not lose money. Very important thing to understand about asset prices and investments is that they go down temporarily, they go up permanently. Okay? Asset prices go down temporarily, they go up permanently. Okay, so it's a wild ride of peaks and valleys, right? But if you look at any chart over the last 10, 15, 20, 50, 75, 100, 150 years, you will see the trends. Asset prices go down, and it doesn't seem like they're ever going back up again. But wasn't 2020 a great lesson for all of us, right, of what could happen with investments and some of the bad decisions we could have made, or what are some of the good decisions we could have made with our investments? Okay, this is a long game. You're investing over time. Real estate over time is going to do very well, even if you use the leverage. Okay? So this is incredibly risky. If real estate goes down 10%, I lose 50 only if you sell. Right? Only if you sell. So give yourself the courage to go out there and just make sure that you can hold for the long run. Okay, and put in that strategy. Okay? So, owner-operated business. Invest in real estate, whether that's your own primary residence first, so it's not going to rent, get in, okay? And then you can invest in investment properties as well. Also, we want to invest in companies that sell us all the products, goods, and services that we buy. Right? I've already told you how lucrative that can be. That's called the stock market. You are owning companies that are in the business of making money. Right? If you want your money to make money, owning shares of companies that exist to make money sounds like a pretty good idea. However, man, just like real estate, it's a bumpy ride, right? Big highs, big lows. Asset prices go down temporarily. They go up permanently, okay? So one of the things that we have is this fear and greed metric in us that really makes us want to do the wrong thing at the wrong time. We love to buy high and sell low. Everything in our gut tells us that as it's going up, I'm missing out. And I gotta get in, right? And when it starts going the other way, we start thinking, oh my gosh, I'm gonna lose all my money. I need to bail. And that's how we lose. So look, if the line is like this over time, okay, don't worry about the timing so much. And so one of the strategies to do is called dollar cost averaging. You are just going to put the money in at predetermined times at unknown prices. What is the stock market valued at today, or the investment that you're investing in? You don't care. Okay, so long as you're diversified, it's a long-term investment, right? You're just saying, I'm going to put the money in, I'm going to buy more shares. I'm going to keep buying. I'm going to keep buying. Okay? And the interesting thing here, the science of money. So let's say I'm buying my shares of my stock or fund and it's worth $100. Okay, and then it goes down and I invest when it's 50. Now what's the average between those two? Mathematicians in the room. 75. But look at this. If I put $1,000 up here, I get 10 units. And if I put another $1,000 down here, 50 goes into 1,000 20 times. So now I have 20 units. So I have 30 shares. So I invested $2,000 to get 30 shares. What's my average purchase price? It's actually $66.67. It's below the average. Okay, so buying at the high, right, isn't the goal, but so long as we buy in the lows, we actually average a lower purchase price. How do I make money in investing? Buy low, sell high. So if I can use a strategy that helps me buy low on average, even if I bought all the highs, I'll do just fine. Okay? You have to participate. You have to get in. You have to get it. You have to invest for any of this to matter. What's the number one most important criteria when it comes to investing? How do you become successful? It's time. How many people have invested in the stock market? How many people have lost money in the stock market? How many people have made money in the stock market? All right. The more time you have, the better off your odds. You guys know that? The more time you have in the market, the better off your odds. I just want to share some statistics with you, right? Because this is a long game. If I take the S&P 500, right? A basket of 500 market cap weighted of the largest companies on Wall Street in the United States. I'm going to look at investing over 1-year periods, 5-year periods, 10 years, and 15 years. What percentage of the time did I make money going back the last 75 years? On average, if you bought on January 1 and you sold out on December 31st, the stock market makes money about 75% of the time. Pretty good odds, right? Some of those down years are pretty bad though, right? Was 2020 an up or down year? Up. It's really hard to guess this stuff, right? Would you have thought that a year ago? Probably not. All right, so investing 5 years, my odds of making money are a lot better. They get to 85%. If I invest for 10 years, it goes up to 95%, a little more than 95%. And then 15 years is kind of that, has always returned positively. Anybody have any money they're going to need 15 years from now? Yeah? If you plan to still be here 15 years from now, some of the money that you have today, right, can be invested in something that over a 15-year period has always made money. You know what the average annual rate of return is over that time? Over 11%, 11.13% over the last 75 years. That's the average rate of return you get on the S&P 500 investing for 15-year periods. I kind of like the sound of an investment that, hey, so long as I can hold for 15 years, it's never lost money and averages over 11%. Sounds pretty good. All right, I got to give it time. Right? I got to give it time. The thing is when we're building wealth, it just doesn't seem like it's working. Right? Anybody feel a little defeated about where they are in their wealth creation plan? Yeah, you probably feel like that in your business sometimes. Right? I was listening to your peers, right? You got to believe, okay? You got to keep showing up. You got to keep putting in the effort. It doesn't get created overnight. Look, the math, though, in building wealth is just, it's horrific, but it's just math. And we have to understand it, right? Anybody take an algebra class during their schooling and go, when am I ever going to need this? Yeah, now. We should have, and look, we just have a systemic problem in this country on financial education. We actually learn the stuff. It's just not applied. So if you have children, get them educated, let them know, right? This stuff matters. But compound interest, we've heard of that. Albert Einstein had said that it was the eighth wonder of the world, strongest force in the universe, right? Compound interest. It's amazing. And as it's working, it doesn't look like it's working. So let me give you some statistics, okay? Write this down. If you start saving $500 a month, okay? $500 a month, and each year, I want you to increase your savings by 8%. So next year, you're going to save $540 a month, and so on, okay? And then I want you to do this for a period of 25 years. And I'm going to assume you average 8% return over that 25-year period on your investments. Okay? How much money are you going to have at the end of that 25-year period? Over $1 million. $1,027,000. Now, if you wanted to start off saving $1,000 a month, well, just double it. It's worth $2 million. Do you want to save $1,500? It's $3 million. Every $500, if you start there with this math, multiply how many millions you want down the road. Right? Okay. Now, here's the sad part. 25 years is what I'm talking about. There's a lot of variables in there where things could happen sooner or whatnot. I think I'm using some conservative assumptions. But let's just say it's over this 25-year period. In 25 years, I save $500 a month, increase by 8% a year, I make 8%, I'm going to have over $1 million. Okay, 10 years into this, you're going to look at your investment statements, you're going to go, okay, I'm almost half the way there, how am I doing? How much money do I have? About $129,000. About $129,000. You're like, Dustin, you liar. I am 10 years into this 25-year exercise. You said I'm going to have $1 million. Right? And I only have less than $130,000. How could this be? Same thing if I'm saving to get to $2 million, I only have $258,000 saved. How could this be? Right? And this is how compound interest works. Anybody here have ever heard of the rule of 72? Yes? Right. If you haven't seen it before, it's so cool, right? Those that have seen it know. It's really cool. So write this down. It's the rule of 72. You guys know why it works? No, seriously, do you? Yes. All right, rule of 72. I take the number 72. I divide by the rate of return that I'm going to earn. Okay, so I assume, let's keep my math simple. I'm going to assume 10% return over the long run. And that's going to equal the number of years it takes for my money to double. So what's 72 divided by 10? 7.2. So let's just say if you earn 10% a year, your money should double in roughly 7 years. Does that make sense? If I had 7% return, it would take 10 years for my money to double. 8% return, it would take 9 years for my money to double. 9% return, 8 years for my money to double, etc. Okay, so 72 divided by the rate of return, that's how long it takes for your money to double. You guys with me? Okay, so if you're like, well, okay, Dustin, I only have, $100,000 here. Well, if you get this 10% return, right, in 7 years from now, that 100 grand is going to be worth 200. If you didn't do anything, didn't add to it. And in 14 years, that $100,000 is going to now be worth 400, because this doubles every 7 years. And in 21 years, that's going to be worth $800,000 if you never saved another penny. And so it looks like it's not working, right? But when you have $130,000 saved towards your goal, you're actually more than half the way there. Compound interest is amazing, right? We have to look at what the future potential is. You have to start saving. You have to start investing. It doesn't seem like it matters. It seems too small and insignificant, right? And you don't have to pick the Nikes and the Apples of the world to be successful, right? You could buy the Apples and the Motorola's, okay? Anybody have a Motorola phone? Anybody used to have a Motorola phone? Yeah, they had 95% of the mobile device market. We all had it. I had a Motorola pager, right? But I could buy both. I've still ended up okay. So look, it looks like it's not working while it's working. Right? That's what's really important, what I want you to walk away with, and how these little things that we do matter. Okay? And it's just math. And it's just math. Okay? All right, let me talk about the 3 ways that people miss out. Okay? There's 3 ways that people miss out. So 3 best ways to accrue wealth. We went over owner-operated business, check. Invest in real estate, many of you, check. Invest in the stock market, check. Okay, so you guys are doing the right things. I want to give you the confidence to keep doing it. Okay? How do people screw this up? How could you screw this up? And we all are guilty of these things, okay? So this is just part of it. Let's write them down and let's know that this is going to be our human nature, that we are going to kind of tend to go towards these wealth destruction activities, okay, that we want to avoid. Okay, number 1 thing that people do that misses out on tremendous wealth is that they want to wait for a better time to invest. I want to wait for a better time to invest. Anybody feel like that? Anybody feel like that right now? Yeah. Of course. And it just always, this is a strategy. So look, this is when you tell yourself, you know what, the market's high, it's going to come down. I know how this game goes. All right, I can't believe it. This is hype. This is overbought. The prices are exaggerated. I'm going to wait to invest at a better time. Right? This strategy almost never works. Almost never. It's just math. Look at a timeline, because asset prices go down temporarily. They go up permanently. Waiting for a better time to invest almost never works, because typically things just keep going higher. And on the road there, they might dip. And when it dips, you're saying, that's when I'm going to buy. Okay? Now, for it to dip and not just shoot back up, you're the only one out there buying. Okay? You're the only one. I'm not going to buy my house now. I'm going to buy when it crashes. You're going to be the only one. Because if everybody else still wants to buy, guess what? It can't go down. You guys get that? Supply and demand. So you are going to be the only one to step in when there's bankruptcies and foreclosures all around you, when we're in a global pandemic that we've never been in before, right? You're shuttered in your house and you're disinfecting your Uber Eats bag. changing your clothes in the in the garage, right? And then you're gonna be like, you know what, I think I'm gonna go buy some property. I think now's a good time. Or interest rates doubled. You know what, I think now's the time to go and invest in a mortgage and go buy some property. Look, you have to be honest, okay? You have to have a strategy, not just I'm gonna wait till it feels right. What is the strategy? This is just an emotion. It's based on greed. We're greedy. And so we think we're gonna get it at a better deal, and you're probably gonna miss out on tremendous wealth creation, because even if you buy and it goes down, is it going down permanently? Temporarily. And it goes up permanently. So don't worry about it. It's a long game. Okay, so number one, people want to wait for a better time. Okay, what's your plan? What's your strategy? Let's get it down on paper. It almost never works. Okay, number two is they invest too conservatively. Right? We invest too conservatively, and so that's based on fear. So greed says, I'm going to hold on, I don't want to get in just now, right? And then that fear emotion says, ooh, if I get in, I got to invest conservatively. When are you going to need this money? 10, 15, 20, 25 years from now. But how do we invest? We act like we're going to need it all tomorrow. And we tell ourselves all these crazy what ifs. What if? What if you live a long life, are successful, and want to retire one day? What if? Right? What are the likely odds of you moving through this world at this point? It's probably not all the what ifs that we say. Does that make sense? Okay? Plan for the probability that you're going to move through this world and at some point want to have financial independence. You got to put it away. Okay? And then you should have that time horizon that gives you that confidence to invest for the long run. And know that if it goes down, it's temporary, and I'm just not going to sell. Okay? So, number one, wait for a better time. Number two, invest too conservatively. Number three, they don't invest. They don't save. We spend all of our money. We guilty of these three things? Okay, it's okay. We are. We do all of these things all the time. And you're going to continue to do them. I just want you to write it down and know that when you feel the inclination to do those things, you're going to hopefully exude some better judgment, because it's wealth destruction, right? You're doing all the effort to be here. You're here. You're doing this business. You're taking your time and your money to come into this conference to try to increase your revenues and be more successful at business. Why? For what? To buy more stuff? To buy more junk you don't want to impress people you don't like, right? Yeah. So we've all heard it, okay? And it's cliche at this point, but look, pay yourself first. Pay yourself first, please. Decide how much you get to pay your future self. Love your future self. Have some love and compassion for the person you're going to be 5 years from now. Have some love and compassion for the person you're going to be 10, 15, 20 years from now. Do you love that person? Do you look at yourself 5, 10, 15 years ago? You're different, aren't you? I mean, you're a completely different person. You probably don't have as much love and compassion for that past person. You're like, you idiot. Don't be like that now, okay? Be the you that the future you is proud of, right? You're going to look out for the future. You're going to make these better decisions, okay? Not saving. We've all met these people or been guilty of this. Say, okay, great, I'm making $60,000 a year. I'm in business. That's fantastic. Let's see. Oh, I spent 62. But hey, I'm in business. It's good. I just got to ramp up my revenues. Okay, I'm up to $100,000 a year. I spent 110. Huh. All right, I know how this works. I got to get this. I'm making 150. I spent 175. Oh my gosh, the more money I make, the worse off I am. You guys know those people? Are we those people sometimes? Right? Look, we have to pay ourselves first. It's too easy to watch it fly out. And a pair of Jordans, an iPod, an iPhone, man, how much are we missing out on every day? So you pick how many millions you want in the future. I kind of gave you the formula. You pick how many millions you want. How many loan signings is that? Right? How many loan signings do you do in a month? I mean, if you're doing 2 a day, you're working 20 days, is that 40? So if you save 10% of your loan signings, is that, I don't know, over 500 a month you're saving, right? That seems pretty doable, right? Pick how many millions you want in the future, and it's going to look like it's not working when it's working, okay? That's the important part. But you got to just keep doing it, right? You got to keep going to work. You got to keep making money. You got to pay yourself first, right? You invest in your business as an owner-operator of a business. Step 1 to becoming wealthy, right? I'm going to own my home. I'm going to invest in real estate. I'm going to be okay with taking the mortgage. I'm going to know that asset prices go down temporarily. They go up permanently. I'm going to dollar cost average into the stock market. I'm going to invest. I'm going to become an owner of the companies that sell me stuff. Thank you, because you own those companies. You're an owner. And I hear all this, this disfranchised relationship with corporate America. It's like, do you invest in the stock market? You are corporate America. You own those companies. You could choose to own those companies. Okay, and you own the same shares as the billionaires out there, right, that own and operate those businesses, just like you own and operate yours. Okay, so I want to invest in other corporations as well. All right? Okay, so I hope that you can take what I'm giving you today, right, to help build a foundation of wealth creation for the future, right? Because we only have these 2 things in life, right? It's time and money. Okay? That's it. That's all we have that you own or control, and there's nothing else. There's literally nothing else that you can control. If you're married and have kids, you know this. You try to control other things, it doesn't work. Right? Look, we talk about our time and money synonymously, right? How can I save some time? How can I save some money? How am I going to spend my time or spend my money? How can I better manage my time, manage my money? Anybody here donate to charity? Fantastic. I'm really glad to see that. I'm really glad to see that, because I will tell you this, all of my wealthy clients, they also donate to charity. It's what wealthy people do. It's a great habit. I'm glad you guys are doing it. So go to a charity and say you'd like to donate, and what are they going to ask? Would you like to donate your time? Or would you like to donate your money? Because you literally have nothing else. And the money isn't real. The money is not real. It's a means to an end. We have to do stuff with the money to make it matter. So you decide. You decide what that money means. And act. Look, I lie to my kids just like my mom lied to me, and I tell them this lie about money, right? And I say, money doesn't buy happiness. Now, I'm not saying you need money to attain happiness, okay? But I would really encourage you to think of your money as it has to buy happiness. Okay? Think of it that way. Right? Now, it could buy me shoes, it could buy me a new phone, it could buy me a new car, it could buy me a new watch. Will that make me happy? Right? It could allow me to have financial independence one day, where I won't have to work, where I can have a roof over my head, I can have my health care paid for. That would probably bring some enduring happiness with that wealth. I can help other people. I could buy happiness for other people with my wealth too. Right? I could help my son, my daughter, my grandchildren one day, help them, right? Invest in their education or their businesses. You can help your peers in their businesses with your time and money. You could help people all over the world through charitable organizations. Actually, after lunch, you're going to hear of a fantastic one that I support, Promise to Kids. And you choose what you do with your time and money. But that's it. That's all we have. Mark, are you able to come back out on stage?
First off, can we give a big loan signing system thank you to our man? Now we got a little standing ovation. I love it, I love it, I love it. Thank you so much, man. Fire.